Hi there, this is Blayne Rush, and I want to welcome you to the program. This is the second of a four-part series on selling your ophthalmology practice. If you've not already signed up for the other two parts, the ones that we haven't presented yet, encourage you to do so. If you're unable to attend the first part in the series, feel free to email me and we'll get you a link to the recording. Let me introduce myself quickly. I'm an investment banker with Ambulatory Alliances. We're a full-service healthcare investment banking and M&A brokerage firm. We have significant experience in advising physician practice owners and owner-operators of outpatient centers. We've advised on numerous transactions and have had various financial and strategic alliances engagements. And we have a lot to cover in this second part of the series. We might run over a little bit in allotted time. If you have to jump off, we understand that. As we go through the presentation, feel free to type in any questions that you have, and I'll work to answer them. You can also email or call me with any questions. And if you'd like to discuss your unique situation, feel free to call me as well. But let's go ahead and get started with the presentation. So this is about preparing the sale. I have a couple of quotes here that mean something about this, because this is a very, very important step in the process. Everything has beauty, but not everyone sees it. You hit home runs not by chance, but by preparation. So the point here is that you understand your business to an extent, and I'll explain what I mean to an extent in a few minutes, and you'll get a better picture of what I'm trying to convey there. But if the buyers and the investors don't see the beauty, don't see the value, don't understand your business, then it's not going to be there in their minds, right? In their eyes, because at the end of the day, this is about those guys. And you hit home runs not by chance, but by preparation. You got to put the time in. And we'll go through this and you'll understand it. But you got to put the time in. And it's very, very valuable. And talking about valuable, let's get into the presentation. What are the goals of the preparing to sell stage? When you think about selling your ophthalmology practice, you as physician owners, people that work with the physician owners, those guys have a few outcomes that they want to see. Typically some of those outcomes are peak price in terms, as well as a corporate partner that'll help with the growth of the business. And in order to put your business in the best position possible to reach those outcomes, you must work hard in preparing your business for sale. That being said, the goals of preparing to sale stage of your ophthalmology practice is where you want to put the business in the most appealing light as possible to as many potential buyers as possible. Just as you would put a new coat of paint on your house before selling, you also want to do that with your business. You should make your company look as attractive as possible. This takes time, effort, foresight. Sometimes it takes a little bit of money. And physician owners might find out a lot about the details of their ophthalmology practice that allow it to run better and put some value-enhancing factors in place, which makes their implementation a good idea for all parties involved. Buyers and investors will find that the prep work enables them to recognize the right acquisition fit when it comes across their desk. Making sure your ophthalmology practice is appealing as possible requires us to look at it in a multi-dimensional manner. Some of the goals here: to increase the speed of the process. And we'll talk about why that's important in a little bit. To make the process as efficient as possible, to manage and increase the overall perception of the buyers, because that directly affects the value. To learn as much about your business as you can, because you'll be surprised to know how much owners of the ophthalmology practices really know about the operational details of their business. There's a lot of things that come out of this process that is enlightening. And even if they don't sell, it's enlightening to the extent that it helps them more efficiently run their business. And we'll talk about some of the efficiencies in a little bit. You want to properly position your business and be able to articulate its investment merits. This process allows for the identification of potential buyer concerns on issues ranging from growth, sustainability, margin trends, case or procedural concentration, quality of earnings, contingent liabilities, and any physician partners issues. You need to understand that the assumptions that drive your financial models. This is very important, as this forms the basis of the valuation that will be performed by the prospective buyers or investors. Use that word interchangeably. Therefore, you must approach your financial projections from the buyer's perspective and gain a comfort with the numbers, the trends, and the assumptions that are driving those. You need to understand the valuation methodologies that the buyers will use in their analysis. For example, comparable companies, which is past transactions in the marketplace, the discount cash flow analysis, sometimes leverage buyout analysis, which is nothing more than using debt. The more questions that you answer up front, the fewer that you must answer during the process to get the buyers familiar with your practice and the practice's story. The longer the business is on the market, and the longer that this process takes, the easier it is to lose momentum. Time kills deals. Speed does matter. Thus, this process matters. Efficiency. The more clear the information you provide the buyers, the more quickly they can determine their interest level in the opportunity. No physician owner wants to waste time educating a potential buyer on their business only for the buyer to indicate they're not interested, it's not a fit. So the sooner that you can help some of the buyers to screen themselves out, the better. Use this process to help you decide which buyers to spend time with and ignore the rest. What happens a lot of the time is that owners get excited and think of the buyers are interested when many times they're not a fit. It's not about, hey, a good business, bad business, or a good buyer, bad buyer. It's all about good and bad fits. So buyers' perception is important here. Buyers are influenced by appearance. The better prepared you are, the better organized you are, and the better you understand and convey your unique message, the better your ophthalmology practice or the business will look in the eyes of the potential investors. The more authentic and knowledgeable you come across, the more believable your story will be, and the more influence that you'll have on the buyers. If you're unorganized or the buyer doesn't see the value, again, like we opened up, even if the value is there, many buyers are going to be turned off and walk away. They're only going to have so much bandwidth and time to put in the process. So the easier that you make it on them, the much better off you are. Physicians too often want to speak about how much money the practice has made them and how great it is, but buyers only care about past performance to the extent that it's a prediction of the future growth. If it's already as good as it gets, then unless the buyer's looking for cash flow or downstream benefits, such as to a hospital wanting the alliance or consolidator, the buyer might not see the value to them. So, your goals, or one of your goals, is to get to know your business in and out, and market so you can convey to potential buyers where the growth will be. You need to show the investors how far you've taken the business, and then how they can help you take it well beyond that. Not doing all of this increases likelihood that the entire story and the potential of the business will never be known to the buyers, again, which equates into less interest or less money for you when you sell. The valuation won't be there. You know, again, I can't stress this enough, but you know, buyers are looking for future value from the investment. Let's move on. How should a ophthalmology practice define its wants, needs, and desires? You know, so this is important because whenever you define that, you're better able to make a match with the potential buyers, the ones that can help you in the situations. You know, so whenever you start the prepare to sell process, or even a little bit before, you need to understand the owners and the practices' wants, needs, and desires. This will help you in a couple of ways, because you know, here's the deal. It will help you get a handle on how you can tell your story. In other words, sell your practice, the strategic position of the practice in the marketplace, as well as understand what you need in a new partner and where the business could go or be, so to speak. Excuse me. Additionally, what do you want out of a transaction? You know, we can discuss some of the typical wants, needs, and desires, but this is a very specific process to each practice and each owner. You ought to ask each partner what they want to see in a buyer and what they want out of the sale. This will help with getting a handle on the question, but also is going to help with physician buy-in, which we'll talk about in a little bit. That's very important. As we discussed previously in webinars, we want to look at this process, this thought process, in a more strategic fashion. We've talked about a SWOT analysis before: strengths, weaknesses, opportunities, and threats. And we're going to use that process as or that analysis to guide you to identify the positives and negatives inside your practice. You know, we'll go through this real quick. The S, which is the S and W, and outside of it, the external environments, the O and T. So that's going to help you develop a significant awareness of your situation. You know, and as you see right here, similar to the one that we've used in the past, and we won't go through that a lot, but know that that's part of this process, and it goes here as well. And the major threats is the competition, and use that as broadly as possible, because anything that you can define as competition. You know, but depending on the size of your practice, we can look at the needs as in a buyer that could help shore up weaknesses and threats, as well as help execute and take advantage of opportunities. You know, let me think of an example. You know, for example, if you're a small practice, you need patient flow. You need to make sure that your buyer can help with that, such as a hospital health system. If you have a lot of referrals or procedures that you're not capturing the technical fees from, then it's possible you need a partner that can help you buy an ASC or capture the leakage, or has an ASC already. If you're a well-oiled, well-run, larger practice, you know, with ancillaries, a surgery center, other revenue-enhancing ancillaries, you know, more often than not, you just need a solid partner that can pay the most, and has the capital that you can leverage to expand and replicate your model, or expand the model, right? So those are a little bit the things, are trying to give you some pictorial examples. How should a physician go about getting buy-in from partners? You know, and you can substitute physician as, hey, how can the CEO or whoever's managing or driving this process, how can they go about getting buy-in from, so let's assume for a second there's 5 physician partners. Might be 15 physicians, or there might be 3 partners and 5 physicians, or 3 partners and there's only 3 physicians. It doesn't matter. We can't stress enough how important it is to have candid and open communication with all the partners. I've seen deals, I've experienced it, where deals blow up at the 11th hour or in the red zone, if you allow me to use a football term, because of trust when it could have been prevented with better buy-in and consistent over-communication. There's no question there's some situations where I advise against being as open as you could be. For example, if there's an owner that owns a small percentage and is very adversarial, then it might be on a need-to-know basis or on a just enough information type situation. But the general theme needs to be one of open and consistent information sharing, involvement, and buy-in. So to get to that point, let's talk a little bit about some of the pros to selling your practice, which is a huge part of getting partner buy-in. Some of the pros: you convert future income into today's dollars with advantageous tax rate. You pay capital gains today versus income rates over time. You take money off the table and diversify your investment. Expand or increase the rate of expansion. Hey, I'm opening 1 new clinic a year. Well, how about you go to 5, 6, 7 new clinic expansions a year, or you're able to buy a competitor, that type of stuff. You reduce your risk exposure and debt. No one has a crystal ball to see what the future holds, so all businesses carry some risk. Better management, contracts, pricing, better physician recruitment and efficiencies, depending on, again, what your wants, needs, desires are. In some cases, you just get your life back, right? Someone else is responsible for IT problems, the toilets that are overflowing, personnel problems, replacing the nurse or office staff, etc. And the physicians can get back and concentrate on practicing medicine. Some of the cons, because those are going to come up and they need to be addressed and discussed. They don't necessarily fit every situation, but nonetheless, they need to be discussed. One of the first cons is you're no longer the only decision makers. Now you have a corporate partner. You have to pay management fees sometimes. And in some cases, even if you're not making a profit. You have to share the future performance of the business, meaning, hey, it's a $10 million revenue company, and it's taken to a $15, $20 million revenue company. It doesn't matter. It's a $2 million, and you take it to 5. You have to share the performance of the business with the other partners. It's possible that you've chosen the wrong partner, and they may not benefit you long term. That's why we have to do a lot of this work up front. You need to speak with the partners and discuss the pros and cons of selling your practice. Keep them informed throughout the process in order to keep the buy-in. Again, I can't stress it enough that this needs to be spoken about early on and not held until later in the process, because it can kill the deal. Buyers and wants partners that are serious about the transaction can make decisions and know what they want and what they don't want. So don't wait until you're in the negotiations stage to educate and get the buy-in of your other physician partners. You don't want them learning about this process, through a drip method or piecemeal through half-truth rumors, which leads to assumptions. Let's see, a question came in. All right. Let's move. How should an ophthalmology practice put together a team of advisors, and who should be on that team? Obviously, physician owners are very intelligent and accomplished professionals, but generally, they'll likely only complete 1, maybe 2 transactions in the course of their lifetime. Yet that transaction or those deals will be the largest and most significant financial transactions of your career. It's by far the largest. And by definition, the inexperience of the novice seller can prove financially questionable, catastrophic in some cases, because what you're doing is you're negotiating, dealing with a buyer's full-time professional M&A team. They have a whole team of people that does this over and over again. And there's many implications such as legal, tax that you'll encounter, compliance issues, negotiation strategies, valuations, business implications, just business strategy type implications. Having the right advisors up front can help you structure the transaction, help you prepare the transaction, all of that type of stuff to mitigate or lessen the risk. So depending on the profile of your business, you could have a team that consists of transaction accountants, your business accountant, transaction lawyers, industry-specific investment banker, key members of your management team. If you're a larger group of owners, then you want a transaction committee that's empowered by the group of owners. Because if you have 20 owners, that's a lot of people. Yeah, you want to communicate with them, but do they have to be involved with every decision, every step of the process? Not sure. But let's speak briefly about the whys behind the group and their roles. You should engage in your accountant and a transaction accountant. They might be the same person. Oftentimes they're not. And this really depends on the size and the tax implications and whatnot. And so it really is deal specific and company specific. But you want someone that has significant experience with business transfers. You don't necessarily have to have specific ophthalmology practice transaction experience, but they need to have physician practice, M&A experience. You need to understand they need to understand that there's different methods that you can transfer the business and the tax consequences of each. Your current accountant might know some. The question is, do they know it all? Meaning all of the answers to the questions that come up. Can they make strategic recommendations? Again, they could be the same person, but you want to make sure that they understand tax consequences. Around the allocation of the sales price. It's called sales price allocation. While we as investment bankers understand, the tax implications, deal structure, et cetera, as far as the accounting side, because of the experience and financial education, we'll point you in the right direction here and there, but we don't offer tax advice. It's possible that you have healthcare lawyers that you call on often. You need to make sure that you have an attorney on your team that is very experienced, where the vast majority of what they do is healthcare business transfers. They need to be experienced with that and the associated deal documents, and more importantly, have the temperament to make sure the deal doesn't stall because they want to argue about and debate some issue that's not very important, or worse, allow their ego to get in the way. I've seen it. The other is industry-specific investment bankers. I can speak for us. We work with physician owners from understanding the value drivers to making the adjustments to their practices, business, talking about the financial adjustments, recast, and all that type of stuff. Capturing internal cases and expansion, making financial projections, defining the market for the practice, and defining the buyers within each market. Then we craft a message that puts your business and its growth in the best light. We market the practice and negotiate the price and all the business deal terms. Even if it's not us, you need someone carrying your flag and negotiating your deal that understands your business and the market. Most of the time, this is very personal to the sellers and less so to the buyer's full-time deal team. Thus, the sellers need someone that's an advocate for the deal that represents the best benefit to them. You need to look at the investment banker's strategic thinking ability, their negotiation abilities, and experiences working with physicians and the various buyers and buyer types. A lot of times you're going to have the relationships out there with these other advisors and whatnot that you can get referrals from and whatnot. I mean, we could list 50 different transaction lawyers right now. You also need someone from your senior operation team that's going to be the point person within your practice. This is the person that's going to collect and provide a lot of the due diligence requests. So they need to understand the business and have access to a lot of that information. You have a large group of physician owners. It's very important that you get their buy-in, that, like we discussed before, but it's too time-consuming to get permission from each partner every step of the process. That's why you need to set up a sales transaction committee, something along those lines. Obviously, if you have a small group, that could be the whole group could be that committee. You can locate outside professional by reading articles, doing searches on the internet, asking other professionals for referrals like we're talking about. We can make referrals. We have deep and wide relationships. You want to interview them and ask for some references. How do you recast and clean up the balance sheet? This is an important one. Most small business owners, they organize their financials and operate their business in order to minimize taxes. There's what we call seller's discretionary spending that are legal but are not absolutely necessary in order to produce the revenue. And the goal of recasting your financials is to show on paper the true economic benefits, or also known as the earning power of the business. What you want to do is look at the historical income statements and balance sheets, and they are what they are, and they are presented as how you've chosen to do the bookkeeping. But most people want to see those cleaned up a little bit. On the balance sheet, common stuff we generally see are payables or liabilities between related parties. Perhaps some physician lent money in addition to equity, and then questions arise on whether it's actually payable, or can that be converted in some form of equity as part of the deal, or how is that going to come out of the partner's pocket? Depending on the age and size of the practice, a lot of times there's fixed assets listed. There'll be a number of assets listed there that were purchased a long time ago, is no longer owned by the business or have been fully depreciated and are now sitting in some storage room, but they're still on the list. They're still on the books. You're going to want to spend time to, cleaning that up, making sure everything is there, and what's not there taken off the books. Oftentimes practices, because the nature of their size and desire to not get things really complicated, will not include on their balance sheets receivables, inventories, etc. It makes sense to take those numbers from your billing system, clean up your balance sheet, and make it on a more accrual type basis, which means that you're going to do it based on what you expect to collect versus cash. Typically, smaller practices are done on a cash basis, which is, essentially what you've already collected. On an accrual basis, you'll have a receivable, some inventory. You'll probably have additional payables above and beyond your credit cards, because credit cards are generally on a cash-based balance sheet anyway. So converting things to accrual is always good because it gives you it gives a truer picture of exactly what's going on. We don't typically see it a lot in the small practices, but it does help the sales process. For a larger, complex practice that's on a cash basis, the buyers will want to see it on a converted to accrual type basis, because you're also going to have, accrued vacation, some other types of liabilities on there, 401ks, pension payments that haven't necessarily been made, but they're required. On the income statement side, you're going to want to get rid of any of those non-recurring one-time discretionary expenses and make adjustments. You'll want to review benefits to the owners, vehicles, items that are not essential to the business, such as, I've seen this, condo on a beach. If you pay for repairs that are listed on the books that were made to a non-business owned assets, donations to your college or your church or synagogue, that type of stuff. Make adjustments to payroll, such as bonuses to your favorite staff member or to your family. Health insurance to family members that are not essential employees. Now, I've seen their cell phones listed on there for family members' trips, etc. All those things will be recasted. There's obviously a slide there that lists a significant amount. But what you can do is you start with your historical financial statement and create these adjustments in a separate column. So essentially an Excel spreadsheet. And then you footnote the explanation, for the buyers. And that's explained for the buyers why you're making these adjustments. You need to go line by line on the general ledger in order to understand and make these adjustments. When we do it, we take the general ledger and we go line by line. And we understand that general ledger backwards and forward to be able to maximize them, those add backs. It's well known in the industry, meaning it's well documented. It's not strange. It's things that's done all the time with virtually every transaction. Even the buyers are going to do it, even if they don't tell you that they did it, because they're trying to look at it from their viewpoint, and you want to be able to influence that. One of the biggest things that we don't like seeing is when you have reports out of the billing system that don't tie anywhere near to your balance sheet or income statement. You're showing what kind of revenue you have, and your income report might show $3 million, and your income statement might show $4 million. Why is your revenue $4 million on your income statement? Maybe you have some rents or other stuff that makes up the difference. I think on the front end, you need to understand why there are differences, and then you can explain them to whoever asks or to someone. If there are differences and you can't explain, then you better dig into them a little deeper, because at the end of the day, those will probably be adjusted out for projection purposes if we can't prove that out. What are the industry value drivers? When we discuss value drivers, we're referring to the value drivers from the buyer's perspective. The value drivers in large part are within the pricing criteria, and knowing these will help you make adjustments to your center, the operations or the financials, whatever, if it's possible. So what are the factors that most significantly impact that? Oh, I went too far. I thought I had another slide, but anyway, so some of the things that are going to be important here: competition, barriers to interest. The multiples will decrease if there's few barriers to entries from others in the area. There are several competing partnerships within your area, or physicians have ownerships and other competing businesses such as ancillaries, ASC facilities, etc. So say that you have a large practice, you guys have an ASC, but many of the higher producing physicians have ownership in other ASCs. That's a challenge. If it's unlikely that you'll experience success recruiting new partners, the growth perspectives are diminished. So that also drives the discount valuation of the business. The multiples will increase if there's significant barriers to interest for others, such as closed contracts, if you have an ASC and it requires certificate of need, if you're clearly the dominant practice in the market, or the markets, if you're multiple markets that you practice in, if there's few competing partnerships in the area, or if physicians don't have investment interests outside of your practice. So these factors create multiple recruiting growth opportunities for the partnership, and you'll receive credit as far as the valuation goes. Reimbursement risks. The multiples will decrease if your practice or ASC or other ancillaries have out-of-network revenue. If it has a specialty concentration that's facing significant Medicare changes, or if there is other risk exposure. Obviously out-of-network payments can boost net collections, but practices with high level of out-of-network payments are generating a level of cash that some buyers will see as not sustainable in the future. So that's an issue. They'll look at it and say there's risk to the profits. The historical trends of the business are important, but what they're really buying into is the future cash flow. So if you expect that to decline, you're getting a discount to its value. The multiples will increase if your practice has strong contracts with the major payers. Obviously, the better the contracts, the better the profile of the business, equates better value. Partnership profile. The multiple will decrease if a significant number of your physician partners are nearing retirement and your practice has no reliable plan to replace them. Another factor is partner concentration. Having few partners sharing the sales proceeds may create incentive for them to slow down or eliminate their production. Also, having a dominant partner creates risk that there's too much reliance on a single individual. So you're going to look at it and say, okay, we have a number of physician partners, but the production's coming from one partner. That could be a challenge. Then also look at growth perspective. The multiples will decrease if there's limited growth opportunity. If there's few recruiting prospects, or if there's capacity concerns, the multiples will increase if your practice consists of partners with growing practices. If there's excellent recruiting prospects, you have capacity to grow, and you have a diverse case mix. Your buyers consider two types of growth when they make the determination. They're going to look at organic and external. Organic growth depends upon the maturity of the individual partner's practice. Each partner is interviewed typically individually to determine their objectives and the ability to bring additional volume or add additional volume to their individual practice. External growth is analyzed based on the probability of recruiting new physicians to the partnership, expanding locations, and replicating the model, be it through de novos or acquisitions out there. Also, something that you get credit for is uniqueness, or something that makes you different. While this isn't spoken about very often, this is something that is specific to certain buyers, and this is specific to the value. And we'll talk a little bit about some of that in a minute and give some examples of what we've seen. Let's see. All right. So what is what is stage 1 and stage 2 due diligence? The due diligence can be a very daunting process for a lot of sellers, because think of this. This is a full physical, the most in-depth physical that you can dream of your business. It in the the phrase due diligence is actually a misnomer. We'll give a cute story about that. It originally was used in connection with public underwriting. So it says that, talked about the liability under the Securities Act, said that, hey, if you did the due diligence and all that type of stuff, you got to pass. Well, it's changed and evolved now to understand that it's a process that buyers go through. Well, we want to stress that it's a process that sellers need to go through as well up front, because it's going to help you understand your business and be able to address red flags that pop up, etc. It allows you to get a very deep and wide understanding of your business, because you need to be able to present your business in the most favorable light. You know, as we discussed early on in the webinar, as far as the goals of preparing the sales stage, prepare your practice where it looks as appealing as possible to potential buyers. You know, we also discussed that the speed of the process, the efficiency of the process, and the overall buyer perception are big components that you want to manage. Well, here's how we get a handle on that. Being organized and proactive versus reactive helps in all of that. And it allows you to get in front of any potential weaknesses that you might have or see. And then you want to be able to craft a message around the options that you see, where you can turn that into a strength and or strengthen that. And we'll discuss that a little bit later. But the stage 1 data and stage 2 data are essentially the paperwork stages and can be exchanged remotely and easily. We use a virtual data room with folders that give different levels of access. Some of the buyers will argue that doing due diligence is a costly process for them, and they'll want some sort of no-shop or standstill agreement in place. That's not real in my experience. And I'm very resistant to standstill agreements in most situations without a breakup fee, but that's another topic that we'll get into later in this series. But you want to be able to proactively provide the paperwork and data, which will help rebut the notion that this process is expensive for the buyers. You know, so this is a list of the general information, and typically when we send this out, the short version, which is the stage 1 due diligence, is probably a page and a half. The long version, which is the stage 2 due diligence, has 22, 23 sections on it. It's about 5 pages long. That process takes anywhere from probably close to 30 days to sometimes 3 months. And in some cases I've seen where some of that information we don't even get till towards the end of the process, because it's very deep and wide. But if we do this up front, we're much better off. The buyers see us much more organized and whatnot. And again, it just helps us. Competitive, what makes us different, and what's the market opportunities. So this is important, and it helps you tell your future story, because this process, we kind of look at it and say, okay, we want to tell our historical story, where have we been, our current story, where are we, and then what's our future story? Because like I've said a couple of times already, is that buyers are buying for the future, and that's where the value is in the future, and to those guys. So they want to see, hey, here's this opportunity, all this opportunity out there. So we'd go back to the SWOT analysis and research the competition and look at what we're doing here. And competition, again, as we talked about when we talked about the SWOT analysis, is wide. So think competition as a very wide definition. the point here is to do an assessment of your practice's business as it compares to not only local markets, but the national markets. What are you doing that other practices should be doing? For instance, example is working with a group that owns an ASC and a retail shop. I know a large group that is active in purchasing practices, and they don't currently own an ASC outright, nor do they have a retail shop. But they're very interested in adding these, and this is an opportunity for them to add that by purchasing the smaller group. This is a way to get that knowledge and expand the service line to their other practices. Same thing with a direct-to-patient marketing program. That's very successful with a staff in place, etc. That is more valuable to a buyer that wants to start a program like that. So someone says, hey, we really believe in direct-to-patient marketing. We know that's an opportunity future, but we don't have that in our stable. We don't have the intellectual capital, meaning the people that know that process and that have executed on it and that have been successful. But hey, here's a practice that does. Those guys are going to be more willing to pay more, are going to be willing to pay more than other people that say, hey, we already have a direct-to-patient marketing program. Do you have other practices in the market that you might be able to merge with and strengthen your situation? Then you take a hard look at this. For example, there's one practice I'm working with that's breaking even or a little bit above, and there's another practice in the same market that's making money. The biggest reason that the one is only breaking even because they're high overhead, and they have less than stellar contracts. Well, we're exploring the possibility of merging the two practices, which obviously going to cut out a good bit of the overhead of one of the practices and would convert the contracts to the other one, and now that business together is worth significantly more than each individual business would be on their own. This all goes to what we have said, and that is inventorying your strengths and opportunities, and then being able to convey your story in the most compelling manner to the potential buyers. And to make sure that you sell or partner someone that can execute on those opportunities. So this process is important in that aspect. And so that's just the same slide to kind of talk about or show you a picture of what the process and how we go about it. So what about its weaknesses? It's similar in the process and the reasonings behind it, but let's talk about it. When you do your SWOT analysis, you'll be able to get an understanding of your weaknesses. And this is the purpose is for a couple things. Again, once you understand your current weaknesses, you can then look to see if you can do anything now to shore up or to increase the value of your business in the eyes of the buyers. Think value drivers. But in the event that you cannot or you don't want to, meaning, hey, it's too much time, too much money, etc., then you'll need to craft the message to help the buyers understand the weaknesses and what can be done about it, if anything. Additionally, you'll want to make sure that the buyers or partners are able to help with those weaknesses. You want to get the right buyers involved. What are some of the typical deal killers? Here's a list here, but let's talk about these. So we talked about earlier that time kills deals, and we discussed how to address this by being very prepared, because what we call I just drew a blank when I looked at the screen, but so the time kills deals, and a lot of this is called fatigue, deal fatigue. So people start throwing their hands up because the buyers keep asking for more information, and it's like, when is this ever going to stop? And hey, want to look at that, want to look at that. And if we do all that up front, then we're much better off, and it helps with that type of stuff. Not knowing what you want can kill the deals, which leads to not being able to make decisions. You know, it takes and goes on forever and ever, and buyers think, well, I don't want partners that don't know what they want, because how am I going to invest in them, and we're going to grow the business, but those guys can't make a decision. Having unrealistic expectation kills deals. You know, sometimes the one physician thinks the business is worth this, another physician thinks it's worth that, you know, and the buyer has a whole different understanding. The one way to manage that is the way that we go about it. We go to the entire market at the same point in time. So we go to all the buyers and all the buyer types, market the business, negotiate it up as much as possible, and that tells you the value, regardless if we do a valuation, which is just someone's professional opinion of what the business is worth. Now it's essentially we're auctioning the business off, and we know what the business is worth. So that helps also manage some of the expectations. Arguing over positions rather than working to find a way to get the deal done kills the deals. Not having your physician partners bought in, you know, they can kill it at the last minute because they're like, man, I don't want this, and then egos come into play because they didn't have a say-so, but they had the ability to kill the deal. I've seen that happen. You know, a bunch of years ago at a radiation oncology practice, one of the nicest in the nation is in the Southwest that you know, they had like 6 locations making a lot of money. That thing never sold. That thing went down in the tube because they didn't have their partners bought in. They didn't even tell the other partners. The dominant physician went out there and did this. And whenever it came down to the last, you know, to the red zone, so to speak, of this, where they punched it in for a touchdown, all these doctors walked. They left and went and started their own practices out there, and this business fell apart and ended up with a bunch of used equipment. Is what you have. Not having open communication kills the trust factor. You know, not disclosing potential snags early on or trying to hide issues. You know, buyers are going to find out all the problems during the due diligence. And if we weren't proactive, and some things aren't necessarily needed, and it's on a need-to-know basis during the process, but some of the big rocks like compliance issues or individual physician compliance issues of malpractice or lawsuits or whatever, that stuff needs to be disclosed up front, because that stuff can be managed. But when it's not disclosed up front, the trust factor and the seed of doubt creeps in, and they start worrying about what else are you hiding. Coming to agreement on deal terms or price and then wanting to change them later kills the trust factor, right? And it's not good. You know, I recently had a deal where somehow the seller, which was my client, got from their lawyer that the prevailing multiple for a practice was 5 to 7 times, right? So, you know, that's not a problem. 5 to 7 times, right? No problem. The problem was that the lawyer understood that it was 5 to 7 times of EBITDA for the percentage of the company that they were selling. You know, so in this situation, it was 50% of the practice or the business. So think about that for a second. 5 to 7 times of 100% of EBITDA for 50% of the business, which in reality was that 10 to 14 times EBITDA. And we had in that situation, had an early LOI come in that I thought was solid. You know, needed some negotiation and whatever, you know, like they all do, but it wasn't 10 to 14 times. And the main selling doc just dismissed it as a bad offer. And because of this information or misinformation out there, we had to do some work. We had to go get other offers, et cetera, explain it to the docs, you know, the dominant docs, et cetera, and able to allow the market to educate the client. You know, luckily I knew the LOI was solid, and I knew the buyers well. Did interacted with them before. We kept them warm in the process, explaining the process, communication chain open, etc. And we end up selling it to those guys for better than the first LOI, but it sure wasn't anything close to the 10 to 14 times EBITDA. You know, some bad advisors and bad advice kills deals because people that don't know the market. Compliance issues, you know, such as medical board issues, billing collecting issues, abnormal metrics such as high percentage of the highest codes. You know, come in there and say, man, you know, how does all these guys have fives, right? Coded as fives. Or a high percentage of a certain patient population getting the same surgery, seeing that type of stuff. Because they're going to do a deep chart audit, you know. They're going to take a cross-section of the payers. So say that you have 50% of the blues, you know, 10% of that payer, 20% of that. They're going to take 50% of the charts that they're going to look at. They might look at, you know, 20 charts, 50 charts, and get a cross-section based off the percentage of the payers. And they're going to look at that, look at the charts, and then they're going to audit the billing and collections. Some of the other stuff that I've seen, you know, billing mid-levels when it's not incident 2 out at 100%, when there's only 15%, or it's only 85% rather, was a problem. You know, those have killed deals before. So, you know, here's a whole list of types of things that could kill deals. So how do you deal with underperforming physicians? You know, the underperforming physicians are a problem in some practices. You know, some practices you have some tenured physicians that aren't very active but are drawing large salaries. You know, that affects the bottom line and profitability, and the buyers will not be interested in having dead weight be part of the business going forward. You know, oftentimes we end up having those conversations because they're tough. They're obviously tough conversations, but they're critical conversations, and they're crucial that physician partners are reluctant to have. You know, so you need to review the production of the providers and address it. If certain providers are trending down as far as patient volumes, procedures, etc., then that's going to show up in the valuation as declining value. The committed physicians are increasingly getting upset with underperforming physicians, and additionally, the underperforming physicians reduce the value of the practice in the eyes of the buyer. So you need to address it early on, buy some of them out if needed, to reduce their compensation. Because what this does, so if the compensation, they're high compensation but low production, that obviously affects the valuation significantly. So those are the questions. I saw a couple of questions that come in. But I also want to talk about, here's a question here that, you know, what do buyers typically do after they purchase an ophthalmology practice to improve it? And then can ophthalmology practice do any of it prior to the sale to increase the value? You know, that's yes, because if you look at the value, the industry value drivers question and whatnot, and play off of that, even in the most advantageous market, many owners of practices leave money on the table when they sell their practice. You know, most often because they don't truly have a handle on what they can do to maximize the multiplier, which is the metric they use to multiply the final price, or they don't want to invest the time and effort. However, the buyers are going to take time. they're going to make the effort to make these changes after they purchase your practice. So I guess the question to repeat back is, do the owners want a multiple of the profits derived from the changes, or do you want a percentage of those changes that you'll get after the buyer makes those changes going forward? Because whenever you sell a business, you're getting a multiple of profits. So say you find another $100,000 of profitability, and I'm making these numbers up just for easy math and illustration, and you sell it for 5 times. Well, that's 5 times 100,000. That's $500,000. That's a lot of money, So some of the things that you look at is, right sizing the staffing level. I'm not saying go cut your staff to increase the profitability on paper. I'm saying analyze it. Look at your business and say, are we overstaffed? And do we really need that staff? But those are good operational things that you would do anyway outside of selling your business. Look at the throughput. Look at, if you have an OR, ASC, look at the OR minutes and the cost per minute. There's some more efficiencies there. Supply costs. Can you reduce supply costs by consolidating suppliers, or be consistent with what supplies you use? Look at and do an analysis on the different suppliers that you currently use and which cases or providers use the most supplies, and see if you can consolidate the different supplies, because a lot of times this physician has this preference, that physician have that preference, and if you bought more of physician A's preferences and made that consistent across the board, it's possible that you could save a lot of money. And you think, some docs will say, well, I'm only saving, $8,000 a year. Well, if you save $8,000 a year times 10, that's 80,000 times 5, the multiple, 5 times 80, you get the point. So you need to know what you're spending per item, any case, procedures, etc. Benchmark your cost against yourself and others. Renegotiate your lease on the clinic, ASC space, equipment, whatever. Renegotiate vendor agreements, all of them. Negotiate third-party agreements. And I understand when people will say, well, I got 4 years, 2 years, whatever left on those contracts. Try it anyway. New patients and new cases are lifeblood. Ask each partner and physician that works there, say, what can you do to bring in more patients, and try to do that. Recruit new physicians to join the practice. Again, physicians and patient volume are central to the success. Because if you have a lot of ancillaries, the practice that attracts additional established physicians will capture that revenue. So say that there's an independent doc out there that doesn't have the ancillaries, but has a decent practice. Then if you are able to recruit that physician over to join your practice, not only will you get their practice cases and clinic volume, you'll also get the ancillaries. So I think that's important. Are there local competitors you can merge with? Think about merging. If you have 2 practices that treat the same patients in the same market, think about it. So those are the types of things that could be done. I know there's a couple more questions. I'll email those out. I think that we're running out of time here. I appreciate you guys spending time with us. If you have questions, if you have ideas, that for future webinars, feel free to reach out. Again, I appreciate your time, and you guys have a great weekend. Thank you much.